Imagine you put $10,000 into the stock market. The market goes up 40% over the next 5 years. You check your account, you've lost money. That's not a hypothetical. That's a documented pattern. And it happens to millions of people who did everything they were told to do. They invested, they stayed in, they believed, and they still lost. Here's the uncomfortable part. The market didn't fail them. They failed themselves, but not for the reasons you think. The stock market, on paper, is one of the greatest wealth-building tools ever created. The S&P 500, 500 of America's largest companies, has returned an average of roughly 10% per year for the last century. That's through world wars, recessions, pandemics, political chaos, everything. If you had put $10,000 into a simple index fund in 1990 and done absolutely nothing, you'd have somewhere north of $200,000 today. So why are most people not sitting on $200,000? Because there's a difference between what the market returns and what investors actually earn. And that gap, that quiet, devastating gap, is where most people's money disappears. There's a research firm called Dalbar. Every year, they publish a study comparing two numbers: the average annual return of the S&P 500 versus the average annual return actually earned by the average investor. Over a recent 30-year period, the S&P 500 averaged about 10.7% per year. The average investor, 3.7%. Same market, completely different outcomes. The market didn't change, the investor did. And the reason comes down to something that sounds almost embarrassingly simple. People buy high and they sell low, not because they're stupid, because they're human. Here's how it actually plays out. It's 2017. Bitcoin is everywhere. Your coworker just made 40 grand. Your uncle is texting you about Ethereum. The news is running countdown clocks. Everyone around you is getting rich, and you're sitting on the sidelines, feeling like an idiot. So you buy in, near the top, because that's when it finally feels safe enough to act. Then it drops, 30%, 40, 60. Now it doesn't feel safe at all. It feels like a mistake. It feels like you should cut your losses before it goes to zero. So you sell, near the bottom, because that's when the pain finally becomes unbearable. That's not a crypto story. That's every market cycle, ever. The same thing happened in 1999 with dot-com stocks, in 2006 with real estate, in 2021 with growth tech. The names change, the pattern doesn't. Psychologists have a name for this: behavioral finance. The idea that human beings are not rational actors when it comes to money. We're emotional ones. Loss aversion is the big one. Research by Daniel Kahneman, Nobel Prize winner, showed that the pain of losing $100 is psychologically about twice as powerful as the pleasure of gaining $100. Think about what that does to an investor watching their portfolio fall. Every red day doesn't just feel bad, it feels twice as bad as an equivalent green day felt good. So you're constantly operating on tilted scales, where fear hits harder than optimism. And the market, which moves in cycles of fear and optimism, absolutely exploits this. Not maliciously, just mechanically. Then there are the fees, and this is where it gets quietly absurd. Most people who aren't in index funds are in actively managed funds, funds run by professionals, people with MBAs and Bloomberg terminals and very confident handshakes. The average actively managed fund charges somewhere between 1 and 2% per year in fees. That sounds tiny. It isn't. On a $100,000 investment over 30 years, the difference between a 1% fee and a 0.1% fee, that difference alone is roughly $170,000 in lost returns. And here's the kicker. After all those fees, the majority of actively managed funds underperform the index anyway. Not occasionally, consistently. Year after year, around 80 to 90% of active fund managers fail to beat the market over a 15-year period. You are paying more to get less, but the fund manager still gets paid. whether you win or lose. Now zoom out a little further. The financial media ecosystem, the channels, the newsletters, the apps, is not designed to make you a better investor. It's designed to keep you engaged. And engagement requires activity. Activity requires urgency. Urgency requires fear or excitement, preferably both. So the headline is never, "Markets calm, index funds quietly compounding." It's, "Is this the next crash?" or "5 stocks set to explode this quarter." Every headline is a nudge. Buy something, sell something, react. And every reaction costs you, either in transaction fees, tax events, or simply the mathematical reality that you bought something overpriced or sold something underpriced. The information age was supposed to make retail investors smarter. Instead, it gave everyone more rope. So what does the person who actually builds wealth look like? Boring. Almost aggressively boring. They contribute regularly. They don't check their accounts obsessively. They don't react to headlines. They don't try to time anything. They hold through crashes, not because they're fearless, but because they've accepted that they cannot predict the future, and neither can anyone else. The dirty secret of investing is that the strategy isn't complicated. The behavior is. Knowing what to do and actually doing it across decades through market collapses and media panics and the very human instinct to do something, that's the entire game. And yet, the system is also not perfectly neutral. Sophisticated institutional investors have access to tools, information, and structures that retail investors simply don't. High-frequency trading algorithms execute thousands of transactions per second. Private equity locks up assets before they hit public markets. The rules are not identical for everyone in the room. So yes, individual behavior explains a lot of the gap, but it doesn't explain it all. Which leaves you with a question worth sitting with. In a market that's generated enormous wealth over a century, who actually captured most of it? And why does the average investor, after all the access and technology and financial education of the last 30 years, still walk away with a fraction of what the market actually offered? Maybe the market rewards patience, maybe it rewards access, maybe it rewards both, and you only get one. That's the part nobody puts in the headline.